Hey everyone, and welcome back to your Money Life podcast. We're on episode 326 of the pod. So do me a favor, wherever you're listening, you like, subscribe, five-star rate, and review this podcast. Let's jump into it. And first and foremost, start with our market update and understanding what is going on in our market. We're going to talk about this deck later. And it's been pretty swell. It's been pretty good for long-term investors, for people that have been investing, staying patient, and also listening to us saying that any blips in the market will recover. So if you look year to date, we're up over 7% on the S&P 500. In this S&P ETF, up over 7% from the beginning of the year. So we're 5 months into the year, just started month five, I guess. Yes, May. And if you're looking at it, we did see again the geopolitical risk that we took hold in beginning of March. The slide started middle of March, and then we bottomed literally at the end of March, and now we're at new highs on the market, which is pretty incredible. If you look a year out, more new highs, over 33%. Look 5 years out, people are seeing 75% gains. Let's look at the QQQ just to get another look on just more technology, growth focused, how that's doing. The QQQ is flying year to date up 12% because all the value, a lot of the value in the market's going to go just to the big tech companies. And what companies using AI that have incredible market share. Think your Google, Amazon's, Facebook's, NVIDIA. That's where all that value is going. And this QQQ index is up 12% year to date. And what does this QQQ hold? Its biggest holdings, top 10 holdings, app by asset size, 8% is NVIDIA. It's Apple, Microsoft, Amazon, Google, both classes of shares. And so that's the companies I was just mentioning. You're going to see pretty much all the value be sucked into those. On a 1 year basis, the QQQ is up 45%. And a 5 year basis, you've 2x your money up over 108%. So we've said just stay in the market, stay invested. People that want to freak out over blips still don't understand the market, and don't understand that these will always pass. They will always pass. Just depending on the time frame, we don't know. The time frame will is that's why we don't try to time every time because the time frame of when it will pass is really really hard to guesstimate. But we do know that it will. So let's look at what's driving some of the stock market movements over the last, several weeks. One of the main things is we're seeing shares of companies rise on different earnings. So DoorDash popped 10% after they had rosy guidance for the second quarter. Fortinet climbed 16%. And so earnings are coming out in stock, and a lot of companies are saying things are well when it comes to earnings. But you have stocks moving higher, oil prices are cooling a little bit, but again, the conflict isn't over yet. But it seems like the market doesn't care anymore. As far as the stock market now, the oil market and oil prices, that's going to be seen still because that's something that has to still work itself out. Um, so it's we're really going back into that bull market territory right now. And that's something to watch out for is what's the next move for the market. Initial jobless claims came in and they rose less than expected last week. Productivity and unit labor costs came in beneath estimates. So new unemployment benefits filed total a seasonally adjusted 200,000 for the week ended May 2nd, up 10,000 for the prior week. Productivity rose 0.8% in the first quarter, less than the 1.1% estimate. So that's another thing. Peloton shares actually jumped, which is a beaten down stock. If you looked at Peloton lately, let's look at Peloton. It's Peloton is their ticker. And Peloton is a beaten stock. 6 months, 23% down. Year to date, 16% down. Over the past 5 years, they lost 93% of value in this stock. This is one of the flying stocks during the pandemic. As you see, here's the the height of things, and now where it's beaten down. So this jump is doesn't do much to me. Doesn't say much. The company has a lot of issues to work through. Incredibly bad service. It's built great communities. It's good product classes, but the services, the subscription model, different things that they're not doing well on. Whirlpool, they lost 18% after it slashed guidance for the full year. And let's dive more into what Whirlpool is saying. They're saying that the Iran war is causing recession level industry decline. This is Whirlpool. So if you're not familiar with Whirlpool, so a bunch of home products and different things of that nature, obviously. They tumbled after the iconic appliance maker warned that the war in Iran triggered a severe downturn, underscoring how sharply higher fuel prices and collapsing consumer confidence are beginning to weigh on big ticket purchases. So they're pretty much saying people aren't buying big ticket home appliances because they're seeing an industry level recession. They're seeing consumers being more conscious and losing confidence, and they have transportation costs of lugging their appliances and their different things from where they make it to where they sell it, and it's cutting into margins. This is one of the starkest corporate warnings yet about the economic fallout from the conflict and contrasted with more resilient spending trends recently highlighted by companies tied to travel and services. So, travel and services, software, SaaS are saying, hey, things are good. Maybe it's big ticket items that people are holding off of right now. They acted decisively to address pricing and costs in the face of rapid deterioration in macroeconomic conditions, but they're still facing headwinds. So I was actually curious because again, this is a bellwether company. People are feeling good, confident, making money. They're going to buy big ticket items. If they're not, as you see what Whirlpool is saying, they're not going to. And their stock took a 20% downturn in after hours trading. So we'll see how that pops goes. McDonald's, they had a good earnings. I'm actually curious on their stock. Look, we'll see. Donald stock. Let's take a look here. So yeah, their stock is actually seen yeah, a little bit of headwinds too, down 10% 1 year, 5 years up 20%. But again, in the near term, it's not been performing great. And it's actually one of the things that they're looking at is it should be a value play here for people, and food restaurants should be a value play for people. But it's been struggling with people, I guess, just not spending. They're not drawing in customers. That's a big, big thing. Let's dive more into it. McDonald's, they're looking to boost sales on more affordable menu items. So their first quarter sales grew by pushing cheaper menu items that appeal to cash conscious consumers. So you see a theme with different companies now talking about the cash conscious consumer, the consumer confidence. They're really looking into that as we go into summer. That's going to be a big, big theme. Um, they reported on Thursday the global comparable sales rose 3.8% compared to a 1% drop last year in the wake of tariffs. So yeah, McDonald's has made it a value menu focus. They're dropping their signature sausage McMuffin below $3. Interesting. So they're making some plays to try to get that cash conscious consumer. But it seems like people are shifting away. It seems like people are shifting away. So that's interesting to note. On McDonald's. Let's look at more current news for companies. FanDuel, I actually thought that was interesting. Thinking about a big betting conglomerate, FanDuel, they're replacing their CEO because the sports book is not having a good run at it. FanDuel, where CEO Amy Howe left the nation's biggest online sport book on Wednesday, so she left. It's a battered stock and a declining market share. It's the parent company is Flutter Entertainment. So we could take a look at Flutter Entertainment stock here as well. Flutter Entertainment, FLUT. And yeah, this is a beat down stock. 1 year down 60%, 5 years down over 50%. So just beaten down in the most recent trading. So they're having an issue there, and they're replacing their CEO, which makes sense. Stock not doing well, the company not doing well, losing market share. They're going to replace their CEO. She did oversee a rapid expansion of online gambling during the past 5 years of her helm, but the stock has fallen as I mentioned, and they revealed in their quarterly earnings a decrease in number of average monthly players. That's interesting. That's actually interesting because I had both DraftKings and FanDuel, and I've just like started using just DraftKings now. I wonder, and I think for one of the reasons why I was like, it was really hard to log back into my FanDuel, but I've just started using DraftKings. I wonder, did they do better marketing? What happened there that they're losing market share? And I think, one of it is the prediction markets coming about and they're becoming more and more popular, Kalashi and those things, Polymarket. they're private companies, but they're eating up a lot of the gambling revenue, right? They're just people are liking that prediction model as well. So that's one item. But she's departing. She's departing. She's getting a severance deal, which makes sense. So we'll see. We'll keep our eyes on that. Let's talk more about the general macroeconomic conditions. So layoffs are down from early 25, except in this one field. So layoffs fell 50% from the first of 2020, first third of 2025 to the first third of 2026, with one glaring exception. Tech was hit the hardest, laying off more than 85,000 workers in the first 4 months of the year. This is according to a new report out Thursday from Challenger Gray and Christmas. That's a 33% jump year over year. The industry announced more than 33,000 job cuts in April alone. The main culprit, artificial intelligence, which was the top cited reason for the second month in a row. So they're saying this Challenger Gray and Christmas survey report that tech companies are starting to cut or announcing cuts, and it's due to AI, they're saying. Over 83 job cuts announced by employers in April, up 83% from March. They're driven by the investments in AI. This is someone from Challenger Gray and Christmas. Second month in a row, AI cited as the leading reason for job cuts. Simultaneously, hiring plans fell 69% from the previous April, in April from previous month. So that's really interesting. AIs, people again are saying that's the reason, and they're using that as the reason. But are we so sure? Are we so sure? I don't know. I mean, they have to invest again. They have to invest in AI, and so they have to make room on the balance sheet for those investments. So that does make sense to me. But a lot of people are also saying that they just overhired over the past 3, 4 years, and some of this is just like a rebalancing of the overhiring, which could also make sense to me. Which could also make sense to me. Folks, we've done a lot of workshops, and so I wanted to take time to actually look at what the workshops we did and actually like go back and go over some of the deck. I thought it makes sense for people to get a sense of like the workshops and a sense of some topics that maybe you've thought about, maybe they haven't been covered in a while, maybe you lost track of it, or maybe you knew and you haven't even heard about some of these, topics and items before. But we invest and we talk about there's tens of millions of dollars that we invest, and people may or may not know what the stock market is, but let's give a brief overview of that and like what it actually means when you're investing. So the stock market is obviously a place for you to buy and sell shares of publicly traded companies. A publicly traded company has certain regulations, rules that they must abide by. They have to provide information to everyone at the same time. Um, but it allows for you to buy and sell shares in publicly traded companies. That's a stock market. It's a marketplace for those things. Ownership of a stock means you own a small piece of the company. Growth happens as companies grow in profit. Stock prices tend to rise. There's major exchanges, including the New York Stock Exchange and NASDAQ. There are market indicators. So there is market indicators that tell us how, generally speaking, the market is doing. And we look at one every week. We look at an ETF fund for the S&P 500 every week. And that's a market indicator of how the general market is doing. S&P 500 tracks the 500 largest companies in the US, often used as a benchmark for the overall economy. The Dow Jones tracks 30 significant stocks traded on the New York Stock Exchange and NASDAQ. And it's a narrow view of the market, but it also has a view. When you invest, there's a trade-off, right? All investing involves some sort of level of risk, right? Generally, higher risk investments offer higher potential returns, while lower risk investments offer lower returns. So you have to understand that trade-off, and a lot of people don't. Your portfolio will reflect risk tolerance and your time horizon. So understanding that you're investing for a reason. Your goal is to retire, to have a healthy savings account, and your investments will or should reflect that. Diversification is key. A lot of people just hear something and they want to put all their money in it, or they hear a friend had a tip or something. You do want to be diversified, and that's what we practice, obviously. You want to protect against just a failure of a single company. And this is general investment advice for career wise or for personal growth and aspirations. There's interesting, different advice that I'll talk to about that at some point. And this diversification does ensure smoother returns over time, right? And that's a fact. There are pretty much a good amount of investment vehicles that there are available for people, but we will focus on some of the main stalwarts. Investment vehicles are just the containers that hold your assets. They don't make money themselves. People often talk about, oh, I put money in a Roth IRA, and they don't understand that a Roth IRA itself, it just doesn't mean anything. It's just an account. It's just a container. Then have to create a portfolio that has securities, which are the things that do things. Securities are stocks, mutual funds, bonds, cash funds can be securities. And choosing the right container can save you money in taxes, but could also have your funds grow. And so, what are the container types investment vehicles? There's 401ks, employer plans, there's IRAs, traditional and Roth, and there's a standard brokerage account. 401ks, it's basic. You only have a few funds you can invest in. Pre-tax contributions more than likely. Your employer may match. We do rollovers for people when they leave a company. We roll over their funds into an IRA. There's no tax implication if you do a rollover. There's no tax penalty. It allows you to control and resume your contributions and allows your advisor to have better investment options because the breadth is opened up for them. Consolidation. If you have all your other accounts in that area, like for our client Schwab, then it allows us to have everything consolidated. IRAs are familiar. There's traditional and there's Roth. Traditional is tax deductible contributions now. So if you're fully self-employed, when you contribute to traditional IRA, you get tax deductible contributions and your advisor grows it. If you're using a Roth IRA, there's a post-tax contributions that are 100% tax-free withdrawals later. So just knowing that is important. So remember, if you're under 59 and a half, with barring some exceptions, when you remove money from these IRAs, you have a 10% penalty. The 2025 limit for the IRAs was 7,000. In 2026, it's 7,500. Um, and those are things to note. Brokerage accounts, maximum flexibility. We use those for clients too, for flexible goals. No limits. You can save as much as you want. The liquidity, it's available anytime for buying a house, starting a business. You do pay taxable gains if you have a profit, but it's minimal for most people. So these are things to note. Remember the foundations. There's a stock market and there's investment vehicles. These are things we want to remember because it's easy to forget them. Super easy to forget. And so keep your mind on that. Keep your focus on that. And we'll share more tips and more ideas and more things for you to hone in on. Folks, that's the episode this week. So make sure you share, like, subscribe, and tune in next week. So we'll see you then.